Everybody, welcome yet again to another edition of 18 Minutes with 180 Markets. You know, how do you invest? How do you make money in the markets? Well, one of the best strategies is to follow the winning management teams. That's right. Follow the horse that consistently wins is a great investment strategy. And with us today, we have just such an investor, or operator, I should say, Ian Lusted from Australis Oil and Gas. Ian is a proven winner. I'm sure he's going to discuss it at length. He formerly, and many of the top Australis management team came from Aurora, which was sold in about, I think, 2014, did very, very well for shareholders. Anyway, enough with me talking. I'm sure you want to hear from Ian himself. Ian, welcome to 18 Minutes with 180 Markets.
Greg, good morning, and thank you for the invitation.
Hey, Ian, as I mentioned, everybody wants to know, how do you win? How do you build a business? That's why people are investing in you. Can you talk a little bit about your Aurora experience and, you know, the positives and negatives and how that helps you going forward?
Yeah, certainly. And to be perfectly frank, Greg, the experience that we gained through Aurora was really the driver for the decision to go again and to try and build upon the experience that we gained. So the Aurora story, in a nutshell, lasted over around about 10 years. It was an early entrance into the US at a time when the unconventional story really hadn't started yet in the US, certainly not in any material way. We partnered with a small but very skilled local operator. We identified several opportunities. And in 2006, we drilled a vertical well not far away from Conoco. And we came across an Austin chalkerite that looked really good. And underneath it, there was sort of this dirty looking chalk from a geological perspective that appeared to have all of the attributes you'd want in what at the time was a very formative, unconventional emerging market. Just next door, ConocoPhillips had exactly the same well and the same interesting results. And it's really around that we built out the story. We were in the right part of what became the Eagle Ford Shale. We were involved in that play all the way through from, we think we drilled the second horizontal well. Today, there are over 25,000 wells drilled now within that play, but we think we were actually on the second horizontal well drill. And so we went all the way through from exploration, appraisal, early development when we got in partners that were bigger than we were and able to fund some of the early development that took place. And then by the time we exited, and you're right, it was in 2014, we participated in about 500 wells, and we'd actually drilled about 30 or 40 of those ourselves as operator, as 100% operator. So we had experience both in terms of the big scale activity of Marathon as our operator and us as a 25% partner, and also we'd managed our own business. And then, of course, importantly, the last thing is that we managed to sell at the right time. A little bit fortuitous, but in hindsight, it was the perfect time to exit. We closed that in June of 2014, and the oil price started to drop in July of 2014. So for us, that complete cycle of an unconventional play, appraisal, development, and exit, we felt was a unique skill set in an Australian context. And we felt there was a lot that we'd learned about what we did well in terms of the elements that had gone well for Aurora, and then what we could actually do better next time around. And they were really the drivers for us starting the new company, Australis Oil and Gas, which was almost a few months later, after we just had a chance to reintroduce ourselves to family after the sale. Then we started back up with Australis.
Incredible. I mean, firstly, the thing that grabs me right away is that you've grabbed effectively the same management team, which means that at some level you all got along really well, because chances are, if it wasn't the case, that wouldn't be. Can you just tell us maybe, and I think this is more for an overall business question and even an oil and gas question, or you can answer it any way you'd like. What was it that you learned maybe that really did work well, you know, and made the difference?
So there are three things in the US that make an unconventional play and opportunity work. The first thing is that you need a low cost of entry. Spending too much to buy into these plays, particularly at the moment, is incredibly expensive, and it takes out a lot of the upside associated with the story. So that's the first thing. The second, and arguably the most important part, is that there's variations in quality in all of these plays. People understand and hear about the Eagle Ford, or they hear about the Permian, But the truth is that all of these plays have good bits and bad bits. We always argued that there was sort of an I Spartacus effect in Eagleford. We were there first, and as the play started to take off, everybody around us started to say, I've got Eagleford, no, I've got Eagleford, no, I've got Eagleford, sort of thing. The truth is that they all did, and at $100 oil, which is what was prevalent at the time, it all worked. But as the oil price dropped in 2014, it became very clear that there were parts of the plays that were very good, and then there was a tier 2 and a tier 3 and a tier 4, and those lower tiers, lower quality rock, simply didn't work at lower oil prices. And so making sure you were in the right part of the play was paramount. And then the third thing is around timing. You've got to get in and out with the right timing. And Australis was set up to try and take advantage of those three different elements. We think we've done it. We think we've actually got an asset that is as valuable or more so than Aurora was. And now it's just a question of timing for us.
That's amazing. And I think that those three lessons are really transcendent across every industry. And that's really a huge lesson for all of us. But also, maybe it's a great segue into, Australis, in the current projects in the Tuscaloosa region. Maybe can we talk about that a little bit? Because I'm sure a lot of people don't necessarily know where that is even necessarily.
Indeed. So, and it's not one of the well-known plays. And maybe if I can, just give me a couple of minutes because it provides some context for it. So we set Australis up to take advantage of that knowledge base in the team, and then to take advantage of what we felt in the US would be an opportunity. The oil price dropped. Most of our contemporaries in the US were heavily leveraged, and we felt that would generate opportunities. So for 2 years, we ran the company privately. We paid for it. We self-funded ourselves. And we spent that entire time, Greg, looking at opportunities, going into data rooms, spending time in the US, evaluating different things that we could look at. And the truth is that in the more established plays in the US, and I should point out that out of all of the unconventional oil production in the US, 85% of it comes from three plays: the Eagle Ford, the Bakken, and the Permian. So most of the activity, most of the interest is in those areas. And the truth is we never found an entry point, an entry cost that we felt matched the risk profile of the opportunity. We always felt like we were giving more away if we were to take up, and to a large degree, follow the sort of herd and the masses in terms of where the focus was. So we started to turn our mind to look for other opportunities. We still wanted to be driven by the same characteristics. We needed that rock quality, but where there are other contrarian opportunities that would be out there that we felt we could take advantage of. And the TMS definitely falls into that camp. It's actually situated, it's a big depositional area. It's about 14 million acres. And in 2010, when the play first started to be explored, the big guys all piled in and took big acreage, companies like EOG, like Pioneer, like Devon and so on. They drilled a handful of wells, and there were a couple of wells that were sort of interesting and exciting, but a lot of them really didn't work. They were very poor results. And the truth is that out of that 14 million acres, only 3 or 4% of the acreage actually works. If those big guys had picked that up early on, then I think the play would have gone and it would have been developed a long time ago. So the big guys drilled a few wells, left, and the play started to develop a reputation. It was difficult drilling with inconsistent results. There were a handful, maybe 5 or 6 companies, of which the largest was Encana, that stayed behind and carried on drilling. They drilled another 70 or 80 wells, which sounds like a lot, but it's not a lot in the US context. But what they did do is they delineated out that really small part of the play where it did work. And then there was a second quirk of history. The oil price dropped. Every single one of those companies was heavily leveraged. They all went through Chapter 11 or debt restructuring, and everything stopped. They spent about $1.4 billion proving that small part of the play worked, and then everybody down tools and left. We went in and we basically piggybacked off of their good work. We only acquired acreage in that core area. We were very, very disciplined in the way that we did it. And the productivity of that rock in 2014 was better than our very best parts of the Eagle Ford that Aurora had, that we sold for $2.6 billion back in 2014. So we knew we had the quality rock. We knew we had the entry point, uncompetitive, low cost, and we knew we had the timing right, because at the time everybody else was concentrating on those 3 other plays,
Right.
And there was no competition for us in terms of building the position that we now hold.
That's amazing. And for those of you that don't know, the companies that Ian just reeled off, EOG, Devon, Pioneer, these are multi-billion dollar oil and gas plays in the US, extremely well known, extremely highly developed. And frankly, Ian, they've paid for, I say that they've paid for your entry, so to speak, is a good way to put it, potentially.
Absolutely. Without the work that they've done, then we wouldn't have been able to be as focused as we have. And to try and give you some context, we were buying oil in the ground and leasing and through acquisitions at something in the region of 25 cents a barrel. So our acreage charges were running at $200 or $300 an acre. By comparison, in the Permian, if we'd gone into the Permian, we'd have been paying $40,000 an acre. That's the difference in terms of entry cost for what effectively is similar economics and well performance and rock productivity.
Incredible, incredible. And also, and so, getting into what's happening today, and, when I say today, over the next 6 to 12 months, can you give us some milestones that you're really looking to key off of?
Yeah, so look, the US as an unconventional business is reaching a new stage of maturity. As I said, most of the oil production in the US comes from those three plays. I'll just throw a few numbers at you to give you some context. The Eagle Ford and the Bakken are older. They're more developed, they're more mature. In the Eagle Ford, between the 5 years from when the play was discovered to 2014, there were 12,000 wells drilled. In that period, production went from 0 to 2.6 million barrels of oil equivalent a day. Enormous growth.
Yeah.
Between 2014 and 19, another 5 years, there were another 10,000 wells drilled, almost the same. During that period, production actually dropped. Why?
Wow.
Because again, we have different quality of rock, and the good stuff had largely been drilled.
Is it also the price potentially?
No, I'm not talking about revenue. I'm just talking about productivity of the rock. We're drilling the same number of wells, roughly, in the same period of time, but we're actually seeing production numbers drop as opposed to sort of very steep growth. Why? Because each well is just contributing less in terms of income because it's of a lower quality of rock. So the inventory of really good stuff in the Eagle Ford is now largely drilled out, and you're left with those poorer quality opportunities. And at this oil price, as you say, from an economics perspective, they struggle to work. The Bakken is very similar. In that same period of time, in that last 5 year period, it grew a little bit, but not by very much. It's largely being consumed. Now, the Permian is the one that everybody talks about. If you follow the unconventional industry in the US, it's a behemoth. It's producing 3 or 4 million barrels a day on its own at the moment as a single play. It's huge. But it has the same issues in terms of quality, in terms of variation. And the truth now in the US is that area has now been largely delineated. The lower oil price helps with that delineation. And as we come out of COVID, as we come out of the slump that we're in at the moment, the opportunities in the US for tier one oil inventory are becoming limited. And what is available is largely now being scooped up by the majors. In that context, the TMS offers probably the only appraised but undeveloped tier one oil inventory in the US right now. There are other emerging plays, but they're really competitive and everybody's been trying to seek and build a position. What we offer at 110,000 net acres, largely now controlling that small core area that was delineated by the previous operators, is a development that's just on a plate. It's just available for somebody to pick up and move forward with. Australis never intended to spend the billions of dollars that it would require to develop this play. Our intent was to aggregate it, and then as we did with Aurora, and it was one of the lessons learned, is bring in a bigger company at the appropriate time in order to actually manage and fund the majority of the development. And we're on that point at the moment. Now, we didn't anticipate COVID happening. We didn't anticipate the last few months, obviously. But the truth is that in some ways it may actually help and be in our favor. It will help that acceleration of delineation in the Permian. And when you talk about catalysts, really the next catalyst is when we're able to start to say that other people are becoming interested in the play. And that could come from either other people leasing and drilling, It could come through partnering for ourselves in terms of starting to bring in third parties. They're the sorts of catalysts in terms of making it go forward. And that's obviously what we're focused on at the moment.
Right. And so at this point, I suppose two things. Can you, number one, just discuss for the audience, how has COVID affected the business, especially over there? Not so much here in Australia, we know that.
So, I mean, it's really two facets. There's one directly, how has COVID affected us as it has everybody else? And then the second is obviously the impact on demand and therefore the oil price.
Yeah.
So your listeners will be well aware that there was a breakdown in what's called the OPEC Plus group back in March. And a combination of Russia and Saudi Arabia put some pressure on the oil price originally. And then obviously the dramatic demand slump that occurred obviously pushed down the oil price further, particularly during the second quarter of this year. So that impact has meant that for a lot of companies that are in that tier 2 and tier 3 acreage, they are struggling at the moment. And in the US, the number of bankruptcies is going up, and the number of companies that are struggling to manage their debt facilities is rising as well. So it is a fairly fraught market in the US. Out of all of that, obviously, comes opportunity. And for us, again, the key driver for us is making sure that we retain the asset that we've got, we safeguard it on behalf of the shareholders that we have, and we look to maximize it as and when things come back. At the moment, the US appears to be reaching some degree of stability. And by that, I mean from a straight oil demand perspective. Obviously, they've had enormous problems with COVID themselves. Right. But in terms of demand for product, refineries are now back up and running, and they're running at near full volumes. They're starting to see the inventory, which obviously grew during that period of time in the second quarter, now start to diminish on a weekly basis. So we are seeing all of the green shoots of heading back towards something that's more normalized. And that's obviously what we're preparing for as well. Directly, COVID has affected us like everybody else, offices being closed. But we've always been a split office business. Right. Head offices here in Perth, operational offices in the US, and therefore operating through mediums such as this, like Zoom and Teams and so forth, is something we were doing regularly every day anyway. So it's been more of an extension of our existing way of operating as much as it has been a dramatic change for us.
Right. And so from an investor's point of view, what are the things, so you mentioned there are a few things as far as to see some announcements about other potential large players leasing, drilling, doing some stuff in the general vicinity of our acreage. Are those the announcements that you would really focus on as an investor right now?
Well, there's two things. And again, if you get to know me, Greg, you'll always find that I'm reasonably honest about these things. So the company has a small debt facility with Macquarie. Right. And I think as an investor, it's important that you understand what that is and how it affects us as a company. We presently owe $23 million as the outstanding debt position. All of our reporting is done in US dollars. Right. Out of our existing revenue from our existing wells, we can comfortably manage that. We work well with Macquarie. They sort of understand our business quite well. Right. And we actually went through a process just to get through the uncertainty of this particular period back in April. We repaid out of available cash about $10 million of the debt facility. And we just put in a little bit of a break for us in terms of covenants, just in case volatility caught us out. Sure. That takes us through to the end of this year. But then going forward, we have a fairly heavy hedge position, deliberately so, to sort of underwrite the business. Right. And out of the revenue associated with that and the forward strip, we can comfortably manage both the existing requirements under the debt facility and indeed the repayment of the principal within the period of time that the facility is standing for, which is out to November of 2023.
So you still have some time.
Absolutely, and we can repay that as we go along out of free cash flow. Even in the last quarter, despite the low oil price, we made an operating profit during the quarter. So we make free cash for the company. So we're a small company with small overheads. We produce something in the region of around about 1,600 to 1,800 barrels a day net to the company. And that generates significant revenue for a little company of our size. And I think we've pretty much been profitable every month that we've been operating and every quarter we've reported on since we picked up the operating and producing assets, which was back in April of 2017.
Right. And is that one of also your major, maybe we're going all over the place a little bit here. One of your major tenets is to have some type of incoming revenue as opposed to just pure exploration?
Look, it's a good point, and I think I should maybe add to that a little.
Sorry.
Don't think of Australis as an oil and gas company. Think of Australis as an oil and gas asset management company.
Right.
Think of the TMS, if you have a generalist as part of your audience, don't worry about the ins and outs of the technical. That's our thing to concentrate on. Think of it as a distressed asset that we picked up at the bottom of the market in 2014. Our job is now to repackage that distressed asset. And as an asset management company, that requires us to do certain things. It requires us to produce the asset and demonstrate productivity, which we do as part of what we do. It requires us to drill some wells and demonstrate future well economics as a start point, as a base point that others can build upon, which we've done, and we've done successfully. So whilst we carry out oil and gas company type activities, it's not core business for us. Core business for us is demonstrating underlying asset value. As we stand today, independent numbers, not ours, but Ryder Scott numbers, they attribute a proved reserve to the asset of 48 million barrels of oil and a recoverable estimate of 200 million barrels of oil. Let me put that in context. That's a higher proved oil reserve than Santos.
That's incredible.
Now,
can you just I have to interrupt you. Can you just talk to the market about approximately where your market capitalization is right now?
Absolutely. I can be reasonably exact. The market capitalization as of 20 minutes ago when we started the conversation was 27 million Australian dollars.
So 27 million folks, plus add another 23 million of debt. So 27, 37, 40, about 50 million of EV, enterprise value.
The only check is it's 23 US versus 27 Aussie as a market cap. But yeah, we're probably 60,
so about
65. And, yeah, yep.
Friends, I don't know if you can do even seventh grade, year 7 mathematics, but that's probably all you need to know.
Look, if you want leverage to oil, then I don't think there's a better opportunity out there. If you understand that the value of the producing asset, not the development asset, but the producing asset, and it's not exploration. We've got over 80 wells now within that core area that clearly demonstrate that future locations and how they're going to behave. It's a statistical work. It always is in unconventional. There'll be better wells and poorer wells. But the average performance is the basis of the future economics. And whilst we don't disclose it from a projection perspective, we do say that even at $50 oil price, each future location has an NPV 10 using our conservative estimates. So that's how much we can drill it for, not a bigger company like a Marathon or somebody like that.
Sure.
It's worth $3.4 million NPV 10. We carry at the moment over 400 future net locations.
So over $1 billion on my numbers.
Correct.
Anyway, Ian, I could spend hours with you discussing this because it does sound incredibly exciting. And what I really, I think, friends, we can take away from this call, not only is this an incredible story, but also some business lessons that we can apply to whatever our businesses are. Ian, in closing, are there any words of wisdom that you'd like to leave our audience with?
Words of wisdom, I'm not sure I have too many of those. I would certainly say that this is where we stand today outside of the impact of COVID is as a result of a very deliberate strategy that we set and put into our prospectus back in 2016, and we systematically implemented each step. Outside of COVID and the share price, we are very happy with where we are. We think we've ticked all the boxes that we need to do. And we're about to emerge into an environment where scarcity will ultimately drive value. And we think we've got something that's really unique in a US context. It simply doesn't exist. And we control it now because we've built it. Our entry costs were low. We've got quality rock that's as good as anything else in the US. And again, we've got a development on a plate. I could talk for hours and hours about this and tell you all the other reasons why it works. But simply say all the lessons we learned from Aurora, we try to apply here, and we can tick far more boxes now than we could back at Aurora in terms of this as an opportunity going forward. So we're actually excited.
Absolutely. Ian, thank you so much. Please keep us up with what you're doing because it really does sound incredible.
Thank you very much for your time, Greg, and thank you for your listeners.
Okay.